there's no reason to be concerned. And people like myself that have been around for a little bit longer than the average person trading today, we know better. We want to see, okay, let the market open up and see what they do with information, this insight, this new sentiment. Does fear grip the marketplace when they send it higher in the dollar index, signifying that it's flight to quality, it's a safe haven move? Um, I don't know because we see gold rallying, and this is why we'll talk about gold in terms of an event-driven market. But right now, dollar index, it could just hammer around inside this range here. It could very well come down in, overlap this fair value gap. And guess what that means? It means I'm not taking that as a long idea on dollar and short on euro or cable. Why? Because I want to see it do what did I mention on the weekly chart? This is where everybody likes to take things out of context and say, but you said this and you're wrong. No, you're not listening. I'm not interested in taking a trade this week until we have a daily close above the upper quadrant on that weekly range that we just showed on the week, on that weekly long wicked candle 2 weeks ago. It needs to close on a daily chart above that level. When it does that, then I'm interested in trading. If it goes through it intraday and it keeps on going higher than that previous week's high 2 weeks ago, then okay, that's the same thing for me. But the bare minimum is that I want to see that close above the upper quadrant of the range of that weekly wick 2 weeks ago on the weekly chart. So I don't even care if it drops down into this. It doesn't signify for me a buy. It just means, okay, once it gets there, I want to see what it does. I want more information. Why am I doing that? Because I'm being cautious. Because I'm going to be risking real money, not demo. Okay, I'm not going to be trading a market replay. I'm going to be doing something with real money. So therefore, I want to have a little bit more assurity behind all the things that's going on around the world. All it takes, folks, all it takes is for something to blow up at the right place, at the right time, in the right country, and all hell breaks loose. And then these markets will start doing things that you've never seen before. So you have to be very cautious. There's high levels of risk right now that you have to appreciate, and you just can't think, well, all these things going on causes great market conditions. Well, yeah, after the event takes place, yeah, but you don't know what's going to pop off next. So you have to be very careful, very, very careful. So hopefully I made that very clear. Just because if it comes back down here, I don't see that as a buy for dollar and sell for euro dollar. If it does that, I'm willing to let it go without me. Not that I'm even trading forex or pound dollar or euro dollar, but for those that are following me, and it's predominantly forex folks that follow me now. But I'm trying to build the audience up with the more gentlemanly traded market or asset class, which is futures. Even if forex falls away, you will always have index futures to trade and commodities. So that's a market that won't ever go away. The imbalance trading into it, it's just something for me to watch and see, does it respect it? If it trades below it on a daily chart and closes below this buy side imbalance, sell side inefficiency, then that means I'm probably going to see a lower run here, and it would need to go through just a very, very small little movement and then snap back higher, and then still resuming with the idea that if it has a daily close above the upper quadrant of last week's range, or 2 weeks ago rather. Let me go back. That's probably just confused you. It needs to get above the upper quadrant of that wick right here, which is again why I write my levels down. And it needs to close above this price level here before me to engage anything. Okay, so I've placed a filter on my engagement this week, and unless it does that, I'm not touching it. What happens if it sells off and goes a lot lower? I've missed it, and I've done nothing with it, and I'm okay with that. How's that for logic? I am very, very careful right now because I don't trust that something wild and unexpected going off somewhere won't occur. I believe it will. So because of that, I'm being very cautious about what I'm anticipating. And if it does this very thing here, I will feel confident that it's going to go higher on the dollar. And it might be a short period of time where gold and dollar move together, which is not historically what you would expect. One goes higher, one goes lower. They're usually diametrically opposed. But because we watch Thursday and Friday dollar index, let me just do gold right after dollar because it's a little bit easier for me to segue. That way I won't forget about it because the chances are I might do it. I might get into a rant a little bit after we close up with NASDAQ and I'll forget and then I'll be all upset about it and I won't be going and doing another additional review. Consolidate and slowly work its way higher. But either way, it should not be moving in the same direction. The BRICS shift staring at Russia and China together in a fortified union, building in opposition to the greenback or the dollar. We're doing nothing. That's what we're doing. We're sitting back and letting them do whatever they want to do because we're technically outnumbered. And it's been checkmate for 2 years now. And nobody really understands that. And all the other nations are slowly siding with those BRICS nations. And you're actually seeing the culmination of that last beast that the book of Daniel talks about. And I'm not going to get into that here, but that's what I see happening. And we are in dire straits economically when that becomes full on and they release their currency where everybody sees it's gold backed. There's nothing holding up our dollar then. And then we will see Venezuela 2.0 right here in the United States. And it's going to happen real fast like that. So because of all those factors that are weighing heavily on my decision making, that's why I'm not also trading in Forex because I think there's going to be a decoupling that's going to happen so sudden that brokerage firms, um, financial institutions, banks, traders, they're all going to get destroyed real fast because it's going to be just like the euro dollar and the Swiss franc when there was the decoupling. That completely, it was like a nuclear bomb going off. I mean, business as usual after that happened, but it was very scary seeing huge runs, 1,000 pip swings instantaneously. You're not ready for that. And I don't care if you're trading on a funded account and you think you're safe. Those things won't be around after that. That's what I'm trying to explain to you. Like that, I'm not willing to invest in Forex because of that very thing that's looming. That's not to say that that can't create reverberations and ripples so large that they wouldn't be painful in futures or commodities or, um, well, I said it, index futures, but in bond market, they'll have them too. But currencies are that's where the target is. Smaller basket to choose from in terms of currencies. And the first thing they want to take away is the dollar and the influence that we've had over everyone else's nation and tried to be the world police and use it like a sharp stick and say, you better do this or else. And now all these other nations that are just as powerful, if not now more powerful than US because they've outnumbered us. On the chess may not be what you're subscribing to. It may not even be your paycheck, even though it's more expensive to buy everything. There's to choose from in terms of currency and ripples. So those things won't be around after that. Everything so large that they wouldn't be painful in futures or commodities or, um, currencies are stick and say you better is because gold's going to be the catalyst behind the follow through higher on dollar, or if it's continuing higher for gold and gold wants to run for the buy side here, if it wants to run there, that means that it might cause dollar to stay in that range I outlined. And then once it gets here, does it power higher? Yeah, which again still would not mean a buy for me. I would need to weigh out what gold is doing at the same time that the dollar index is dropping down into that daily fair value gap. Okay, so there's this teeter-totter effect. I'm balancing out two markets that are closely correlated, but they're usually inversely correlated, meaning one goes up, the other goes down. But because of all the things that's going on right now, they're moving in tandem. That's not a normal function or symmetrical market. You want to see a market environment where you're willing to take on risk, where they're doing the opposite of one another. that is a bullish on dollar. That should be weakness on gold, or there should be no strength in gold going higher, and all foreign currencies should move lower. Equities should start going lower and have a short-lived rally. If it does rally, they're suspect rallies, they're fake rallies. They're just going up to go into an inefficiency and quickly reject it, or go up above a short-term high, then reject it. That's how you use the dollar index. But just because we're bullish or bearish on the dollar index, if you're not factoring in the effects of gold, because gold is the qualifier of dollar. So you're not just simply looking at dollar index and thinking, oh, well, it's going higher. You can't just look at dollar index going up and assume everything else mark to market should go lower. It doesn't work like that. Forex pairs and forex currencies, those types of markets, yes, they many times will work marked for market. Mark to market, it'll be usually on par. Euro for certain, because the dollar is heavily weighted with the euro. But other currencies like the pound tends to do whatever it wants to do. Pound is like the NASDAQ of Forex. Yeah, it might bend the knee to, lower prices on whole, but it's going to buck back when it wants to and be unruly. And also, when it does move, it's going to move in an accelerated pace, just like cable does. Cable's pound dollar. So when the market's predisposed to go higher or lower relative to the dollar index going higher or lower, euro is tending to move mark to market with what the dollar index does. But if it's bearish for euro and bullish for dollar, cable can over deliver and be exaggerated to the downside, which is when I was trading Forex. That's why I elected more times than trade. Just why I trade with my overall macro analysis. I move, I'm wrong in my analysis. If I'm wrong in my entry, then the market that's going to. So anyway, that's enough for gold. That's what I'm using it for. That's how before we got to this market. I've talked about gold, so now we can go into euro. All right, so here is the weekly chart of along with that. And in my experience with a lot of books, reading, stuff that really is regurgitation, I didn't find a lot of value in that stuff. So there's a whole lot of other factors that aren't ever really discussed that I just shared with you. So hopefully it'll, carry you through your career with help. So we had this volume imbalance. We traded up into that. It's just all old news, and it's moved lower. We went below here. These relative equal lows. We had sell side taken. I did not say that we were at the bottom. Um, and the same thing I'm saying in terms of the dollar index. I think that we gradually move higher on dollar, but as to what catalyst that is the what's the driver? Because if we start seeing a lot of terrorist attacks, if we start seeing a lot of those things happening in mainland U.S., um, the dollar index is going to go parabolic. Like it's going to go straight up. And that also might accompany a rise parabolic in gold. If we see those types of things occurring, like buses being blown up, buildings being blown up, things happening in the New York Stock Exchange or near the New York Stock Exchange, or army bases, military bases, and things of that nature, or large gatherings of people. Okay, and we start seeing the stuff that goes on in Gaza and in Israel. If that starts happening here, that's going to cause so much chaos and fear, and these markets will rev that up, and it'll exaggerate it and cause people to be fearful about their money, and that's what it'll be used for. So Europe, this type of thing to occur, I'm still selling the idea that that's what I believe is likely to occur. Colors. So I think that if our will be accelerated by the thing, it does happen. It's going on around the world, and there's no inefficiency in here that I feel is noteworthy to high me as discussing today. Be able to do any of that stuff. I'm what's going on over in Gaza, what's going on with Iran, what's going on with um, all the other Arab nations. I'm watching all of that. That's where southern border. We don't know what's going on. We don't know what's going to pop off here, but it could get real busy here beyond what you expect. If we expect well, border, that's the midpoint. That's not going to be just of the dollar going higher. We start seeing the dollar index resume going higher. Because that's the catalyst, high, lower, low. There's only this gap here. We went over top of it here. We overlapped it, right? There, went through it. Does that mean it's gone? No longer considered worthy? No. It means that my eye jumps right to this, and this becomes a potential inversion fair value gap. It's a pay at the halfway point. Expect of risk rate and trade, where if I'm wrong and we gap a lot against me, I what it does after that opening price is made and where we closed the previous week. So that's your opening range. Respect, meaning that if we trade at one below, way I would do with it's not random. It's very specific things. And then unless it does these types of things, I would not take any action on it. And regardless of whatever the market does, I can be comfortable and not have any FOMO. I'm not fearing of missing out on any of these moves that takes place because what I've framed out is what I'm comfortable with, and incurring risk around it is an acceptable thing for me. These things may not be what you're subscribing to. It may not even be your model. You may have something entirely different that you're trading with. And you think that what I just outlined here makes no sense to you and you wouldn't use it. That's your business. You're welcome to have that. But for me to have something where I'm going to show you an example, this is what I did. This is how I used the information I talked about on Sunday before the market opened up, because you can see right here, everyone, the foundation, put $6,000 on a position that I'm comfortable. If they're met this way, I can take a trade like that and feel confident that I can get 50,000, 75,000 out of the market off of that move. So everything's relative. Down big moves can happen. I'm not just going to sit down and wait for something that just feels right. I need to know that I'm using the higher time frames. I know that I'm referring to and conferring with other markets that are anything can pop off and change everything, whether it be my opinion or fade something else. You're not going to know what you're doing. You're just going to be doing something for the sake of doing it versus investing. If I take the trade based on the things I'm sharing, at some point, I love all inefficiencies dollar, and you're not using. So let's close the line. Receiving from me and not just wasting time talking about something. If you're getting some value from it, that's the report card you give me. That's our currency here. It doesn't cost you anything to do it. There's no PayPal required. So we have an inefficiency here on the weekly chart. We traded up into that last week. Let me actually go in a little bit more detail. Okay, so we have an old low. Get down into it to see that close. Get the low out here. Seller, so cable we have to work out this area here where it has to close below the lower quadrant of this wick or tail. This would have normally been a breaker where we had a low, high, lower low. And if it was bearish for dollar, then this would have set up a bullish breaker. No necessity to trade down here at all because there really isn't a ideal fair value gap. There is one here, right in here, but that would have never been one too deep for euro. I would treat it at the time and estimate or what color wrong. But inversion fair value gaps, I'd like to keep this color scheme for it. Something this would be otherwise. I would expect it to go back up, touch the low, definition, high probability. Now, it doesn't mean that what I just outlined here is going to pan out. It's just probability. I'm interested right now in this patterns that you are looking for as your model. Do they manifest? Study its fair value gap. A fair value gap that fails in its function of bullishness or bearishness, if it fails, it will become an inversion fair value gap and get wrestled through something that makes sense. You're doing things that are sound. There's logic. You're not to that range low, which is this candle's high. So that fair value gap has been repriced to offer the buy side that's been given here if, see, this is the part you don't want to hear. You want me to get to the nitty gritty and make it easy. Here's to buy, sell, and expect it. But if you want to learn how to make money and consistently know what you're looking for, why am I using this candle? Why am I not doing this? And why am I expecting this range to stay unfilled? And why should I expect this one to be filled? Well, I'm teaching it to you, but it can't be done in a 5-minute video. If this candle didn't trade down into the upper portion of this fair value gap, if it didn't do that right there, then the one pass through it where I expect the fair value gap to fail here, not offer support, then I would treat the inversion fair value gap as it can go all the way to the high. Why? Because it wouldn't have had this drop down in the upper portion of this range. See that? But because it did that, it's already offered a measure of sell side. So between that candle's low, which I'll highlight here, what I'm saying is essentially is I don't want to see it trade above that blue line. If it trades down, worst case scenario, it can create a mohawk, which is a little tiny little deviation above or below a level that would be the level I'm looking for to be respected. But because markets are factoring a spread, and we all know what you actually get, and how often are you really checking to see what you paid in spread? You're not. You're just hoping to get in there because your fear of missing out is so high. That difference between this candle's low and the high of the fair value gap, which is this limit here. So I'm going to highlight both levels. I don't want to see price if it trades down below it. I don't want to see it trade back up in between these two levels once we get below this shaded area. Gap, it's already A, and then it comes back, but it portion. If it accelerate, this this candle has buy side inefficient in sell side. Very low, that candle here, it didn't respect that. It traded. Then I would expect, and I would try to take a short higher up here, a major dent in your understanding about inversion fair value gaps here. I tuck it in to these long-winded videos because these are the details. These are the details that. Let me make sure I didn't break my phone here. I told myself when I laid it on the armchair next to me, I'm probably going to drop it. And that's good. Just last until November 12th because I'm turning this son bitch off. So now you have insights. When do I expect the fair value gap to fill? Why would I expect it to fail? Why would I like to see things remain open? I covered all that right here. Okay. So in my book, when I talk about inversion fair value gaps, I'm going to cite this very video where I walk you through the explanation with an example, because everything I just said in text, you might read it and say, I don't understand what he's saying. But now you've seen me outline it. You've seen me refer to it here. In every example where I've ever shown the trade where I've used it and you watch me call an inversion fair value gap before the market itself respected it as such, now you understand the dynamic of what I trusted at the time. Because it's not make-believe and it's not hindsight. It's logic that's being referred to on an ongoing basis that will tend to repeat more times than it will fail. And then in and of itself, that is an edge. That's a model. That's something you can put statistics and probabilities behind. And if you can determine when the market's predisposed to go higher or lower, that by definition gives you high probability. And if you can't do your trades with that mindset behind each and every one of them, you're gambling. You have no idea what you're doing. You're just hoping and praying. And when it's right, you'll call it skill. When it's wrong, you'll blame me. You'll blame the methodology. You'll blame the broker. You'll blame the market. You'll blame everything else but yourself. So this discussion is just reverting back to you as the responsible party. When you do it wrong, you did it wrong. Everything else is exactly what it is. It's separate from you. These gaps don't make you buy them. They don't make you short them. You decide that you make that decision. So I'll move on because I could go on a lecture about that. So let's go into the 60-minute chart. All right, and same thing here. We had a Civi breaker. We traded up into both of those. That is a very, very strong model when you're looking for sell side. Everything reversed, you can use it for when you're looking for buy side. It broke lower. We traded up into the inefficiency here. And this is one of those things that I got burned many times on Sundays where I had this very scenario here where it looks like, okay, we traded up into that. And if we opened up inside this fair value gap here, I would go short right there on Sunday and expect Sunday going into Monday, London, it would just trade lower. And it wouldn't do that. Sometimes it would go higher, take the buy side that I would be treating as my stop, and totally, prevent me from being profitable for that Sunday's trading. It was this very thing here that caused me to stop trading on Sundays, where I used to take trades on Sunday. When we would open up, I would trade, the first 3 hours or so of Sunday, and then pack it up going in around 10 o'clock. You do whatever I normally do if I'm going to nap or whatnot before London session, or if I went to sleep, you know, that's what I would do. And then come back in London and see if everything was in the same vein of what I had hoped for. And if it gave me a trade, I would trade in the London session. But because of all the things that's going on that I've talked about in the earlier portion of the video or the live stream here that you're all listening to, the wartime events, the terrorist events, the uncertainty and the likelihood of it happening in all of our backyards, all that stuff could promote enough fear, and they might want to to start revving that fear up by having a gap opening lower, then come up, reprice to close the gap between where we closed on Friday and where we open up here today, later today at Sunday. Um, Close that gap and then go lower. And then I'd like to see it trade below that gap and not offer support. I want to see it fail. What happens if it trades down to this? It treats it as support and rallies back up. I won't be long. I'm not trading Forex, but you shouldn't be upset about that, because what you're going to be treating it as what? Inversion fair value gap. There's always going to be moves that take place that you didn't see coming. But here's the wonderful thing. You didn't lose money. You're going to beat yourself up about how much you could have made if you just would have took that trade, but you didn't see it coming. So how you going to punish yourself like that? You're wasting mental capital doing that. You're literally causing mental drawdown on money that you never really risked, and you can't make money thinking and worrying about it. So by having these pre-market opening expectations and running scenarios that would allow you to feel comfortable taking trade, and what you would be comfortable letting go without you being a participant in, it helps free up that, well, permission to give yourself, so that way you don't feel impulsive to chase price, because you can see it trade down in that fair value gap and it starts to come up a little bit and you're thinking, oh man, ICT's probably got it wrong. What if it does run 100 pips higher? That's 100 pips that I could make, and I can come back and say, ICT, I faded what you did, and haha, I feel great. Wonderful. If it happened, it would be great. But are you going to feel comfortable in the trade? Probably not. You're going to be hoping and praying that it works out. And you won't be looking at what the market's telling you while you're in it, that might tell you it's going to fail, and then do what I'm outlining here, which is trade below this gap. So there's a lot of different ways you can use what I'm telling you and what I'm explaining. Okay, all I'm saying is just be responsible with whatever it is that you're doing. You own it. If you make money with it, you did it on your own. If you lose money, eat it. All right, so let's go over to S&P. Get through these real quick here now, because I am getting hungry, and you're probably gonna start hearing my stomach growling. I don't eat the crepes. I tweeted about that this morning. I make breakfast for my wife. She likes to have that stuff. I just had oatmeal. All right, so here's the weekly chart. Here we had the market rally up in recent months. We were expecting the market to trade up into these levels, and then I gave you an outline for a bearish scenario, looking for a quarterly shift. That means every 3 to 4 months, there's going to be a shift in market structure where the market can move, sustained moves for 2 to 3 months, but as long as 4 months, because there's a little bit of an overlap where it's not running on a perfect 3-month calendar. Just because we say quarterly, that is not broken up equally into every 3 months. It can go a little bit past 3 months, and it could be as short as a price run of 2 months. All I'm stating is when I'm looking at higher time frame weekly and daily charts, I'm looking at how we could, for the next series of up to 2 to 4 months, where could it be reaching for? And I have these levels in mind, and I have them written on my pad. Okay, so my little notepad has higher time frame monthly, weekly, 4-hour levels. And they are very significant draws on liquidity for me and my trades. So if I think that there's going to be a draw to a very low level, like for instance, say 4,200, not that 4,200 is one, but for the sake of discussion here, say 4,200 is a level that I felt is, something of importance, and that we could reach down there on a longer term basis. Any trades that I would be taking that's short, and if we get within, I don't know, 20 to 30 handles, I would likely be at my maximum risk, which is 5%. If I'm taking trades that would be moving away from my monthly, the weekly, daily, and or 4-hour levels, I'm not going to trade with 5%. I'm going to trade with like 1.5% maximum leverage. So the benefit of having all these higher time frame levels is to know when you're going to push the envelope of your risk. If it's more likely to pan out and go into these higher time frame levels, then I'm confident that my intraday trade executions are very, very tight. They're very specific. They're very extremely precise. I know what I'm looking for. I know when they're going to likely form. And if I can frame them on the basis of moving in the direction and it starts getting real close to these higher time frame levels, then I'm going to go with my maximum risk, which is 5%. Okay, that's how I ran up those MT4 accounts. Okay, when you saw me run those things up, I was doing every single time I took an entry, I was using 5%. Every new partial or every new pyramid entry, in and of itself, that new entry was 5% risk. So some of those trades would have as much as a 20% impact on that account. But when you're running it and you're getting hundreds of pips, it parlays it up fast. It's math. That's all it is. It's not a rented MT4 server. It's not Photoshop. Sorry. Anyway, no extra charge. So we went up into this SIBI here after working into a old low. So trading up into that. Um, can we revisit this high? I'd prefer that it didn't. So I would like to see it stay. I would like to see it stay in the lower portion of this wick. Okay. So I would like to see, if we have any kind of rally up this week, I want to really see it stay below the 43.91 level. So I'm expecting a little bit of movement around in there. It can start to gyrate towards that direction. I don't want to see a close above 43.91. I don't want to see that, not on a daily basis, because if it does that, then it means we're probably gonna have to run this high again and maybe work up inside this area where the volume imbalance is residing. I like the fact that we didn't get up to the volume imbalance, because that to me indicates that it's heavy. It didn't want to close in all of the SIBI, which is a big down close candle, and it didn't even want to get back to the volume imbalance. So there's two factors that would be constituting a premium in the range of this high to where we made that low. So we were unable to get to the volume imbalance, which would be here. So your chart would look like this. When we rallied up last week, we did not get to this volume imbalance, and we left all the portion here open. This is the sell side imbalance, buy side efficiency low, and it's the high of it. So it would look like this shaded. If you're learning, you can hit that like button. It would be a great appreciation by me. And we didn't get the consequent encroachment of the city. So what does that mean? There's three things that would be normally viewed by me as a premium array. We couldn't get there to any of them. So that's nice. So when I see that, the logic is, okay, we have this big wick. So now because we have that wick here, I don't want to see it trade above the halfway point of it. I want to see any retracement back up be maintained and held within this range here. There. I'll take this off so that way you can see it. So any movement to the upside, I want it to be limited to good grief. There you go. To inside that range. Okay. And that is 43.91, nothing higher than, and in between where we closed here. So it can do anything it wants in here. I just don't want to see it go above here on a closing base on the daily chart. As long as it does that, I'll remain bearish for ES and bullish on dollar. So you see how I've taken all the markets together and put them together like a puzzle piece. That doesn't imply or ensure that I'm going to be correct, but I'm telling you how I teach, how I use these PD arrays, how I'm using intermarket relationships, how I'm factoring in this geopolitical and wartime event where it creates a great deal of difficulty because you don't know what's going to happen next. You don't know what responses are going to be by different nations and countries. And you don't know when it's going to pop off in your neighborhood. And all that stuff creates a great deal of interest in the market to speed up and rev up fear. So because we're in this condition and we're in the final quarter of the year, any animation in price is going to be exaggerated. It's going to be exaggerated. It's going to move a whole lot more. Your targets, they're going to be easily met, but they're going to be probably blown out and they'll go way past them. And you'll see them probably go to levels that I can't perfectly go to a methodology and says, okay, this is what it reached for. It just goes beyond them. That's how you know that they're utilizing fear. That's manual intervention. But if you are looking at instances where we can still take trades and be acceptable of the risk that's involved around them, weighing out the risks and still allowing for the best case scenario where we get the best of the best. So when you have a trade target, these are the conditions where you want to go and say, okay, this is where I want to get out at. This is the perfect exit. You want to have 80% of your trade taken off before that, but leave something on to go past your best case scenario exit. That's the kind of climate we're in. You don't see that in books, and it's hard to articulate the reasons why and when you would trade like that unless you're in these environments, which is exactly what I taught in my mentorship. That's mentoring. You're watching things and understanding the logic when I'm explaining something. And I sound very verbose about a lot of things that may not seem like it's all that impactful to you or useful to you. But for someone that's been trading for a while that has made money and knows what it's like to be in conditions where they just didn't feel like they were dialed in or knew what they were looking for or something surprised them. I'm not usually surprised by very many things. I'm not. It doesn't mean I'm right all the time. It just means I'm not surprised. And I know that the climate that we're in right now, certain characteristics tends to manifest itself in a way that I'm describing here in this lecture today. Any other time when we don't have the wartime events, we don't have the potential of terrorism popping off everywhere, um, then no, then I wouldn't expect this. It would be here's the best case scenario target. I'll still get out of 80 and I will go one tick or two below what I think it's ultimately trying to reach for, and I'll be satisfied if I get that. That's a normal functioning methodology for me because my weaknesses are my exits. I want them to be perfect, but I have not been able to be perfect consistently in a manner where, if you look at by contrast, where my entries are, they can be deemed phenomenal. But my exits, I'm not satisfied because I'm using multiple time frames many times to ascertain what those targets may be, and I don't know which one at the time I feel comfortable settling with. And if I'm watching multiple time frames, if I'm teaching while taking the trade, um, if my son's sitting next to me and he's asking questions because he's impulsive, he's a young guy, that might change my mind about something because now I'm going to be thinking about what he asked me, and I was willing to submit to this target, but now I'm wondering what he's thinking about. So can I think about my trade objectively if my heart's interest is to try to get my son to learn how to trade? He's asked the question. Now I'm going to try to think about how I can better answer him. So my focus is now broken. So there's a lot of things that takes place when you're trading. And if you're trading with real money, these decisions are heavier, not just going in there and watching a tape read, or you're not really pushing a demo, you're not really trading with a combine, you're not trading with a funded account. You're you're trading with real money. And when you're at least I can only speak this from my personal perspective. Once my concentration's broken, I'm done. Like I have to close the trade because what will happen is my bipolarism will kick in, and then what will happen is my rage will take over the management of the trade, and that's what has hurt me when I was in my younger years. That's the very thing that would take place, and I wasn't able to identify it. So whenever I lose focus, whenever that is, and whatever the catalyst was that causes me to lose focus, I have to take myself out of the trade. And if it goes to my targets that would have been filled if I would have stayed in a trade, or if it goes way beyond it, I've just grown to accept the fact that I can be imperfect but profitable. And it's a very forgiving state of mind. And that's what I try to teach you. I try to teach you to have a low hanging fruit objective. And over years, not a week, not a couple months, not just the first year or two, over years, you will get better and refining it. And one of you, as my students, are going to come up with an amazing exit strategy that is uniform. This is what you do all the same every single time. You're going to use this method, and you'll get this high degree of accuracy. I hope I live long enough to see it. I'm confident that that's what's going to happen. I've given enough resources and ideas for some of you, if not one of you. You're going to come forward and say, "This is what I found out that works for me," and I might end up utilizing it for myself. And I would be open up front and say, "This is exactly what I was looking for, and you found it for me." That would be wonderful. I would love to be able to do that. But until that happens, I wrestle with imperfections in terms of what I'm comfortable with settling with a target. So anyway, I just tossed it in there because I felt like it needed to happen. Daily chart on ES. Um, yeah, we don't want to see it trade above here on a closing basis. So we'll get this off here. All right, so uh, there is no inefficiencies in this run here, but we did do what? Look real close. I'm not going to say anything. I want you to look at it. We have just crossed over something that might be impactful going forward. Had to sneak a drink. You look at this candle's high. This candle's low. All right, now let's play devil's advocate for a moment, okay? Say we gap down at the opening. We have a gap lower opening, and then we trade back up to here. I would like to see this trade just to the low, not trade to the top, be permissible to trade to the midpoint because this is a fair value gap. If we're bullish, this would be expected to offer what? Support and send price higher. But if we're bearish, what would we expect to see this do? Fail. And this is what happens when jokers literally look at things and they talk about something that I didn't talk about, but they'll point to a chart and say, look at this. This is ICT stuff failing. In your hands, it's failing because you don't know how to use it. But in the hands of someone that's proficient, and especially the person that's created it, I'm telling you how I'm using it. This fair value gap fails and it gives you insight. Now, if everything were to happen, so we have a gap lower opening, say we gap lower than this candle's low, okay, we gap lower than Friday's low. It can trade back up to this fair value gap's low, have a mohawk that could reach to consequent encroachment. I prefer it didn't do that. It can go to the low and maybe a tick or two above it and not trade to consequent encroachment and certainly not trade to the upper portion of it. Why? Why would I say that here? Because we have had this candle go completely through and below it. Look real here, look real closer here. You are getting a PhD level in terms of price delivery today. No charge. See how we ran through this gap here? This whole candle here went all the way to the high of the gap, which is this candle's low, to and through the low of the gap, which is this candle's high, and we create a little tiny little mohawk right there, colored outside the lines. That's completely permissible. That's acceptable. We are not afraid of that. Then this candle here, we trade down through it entirely. So now what did we do? Did we have any respect of this gap? Nope. Is that a bad thing? No. That means now if I get an extreme gap opening because it's the weekend, we don't know where we're going to open up on Sunday. If we open below this low, we're really technically oversold. We don't even care to tell us that. We're really oversold, and then they'll reprice against the opening price because everybody's going to want to do what? Chase it lower, think it broke out to the downside. So they'll enter right away because the market started opening up and it's trading. So now it's time to get out there and and chase after investment profits. Let's just get out there and go do something. It's the weekend. I ain't working. Let me go out and just do a trade. And it runs back up and touches the low of that fair value gap. I would like to see it do that and then roll over and go lower. Aiming for this day's low. Why? Because it's a daily low. And then see if it can gravitate towards the sell side resting below here throughout the week. It may not happen this week, but gravitating towards this area down here eventually. But treating this as a premium array and expecting it not to need to trade to the higher end of it. Now, how do you use that information? If you're going to use this as a mechanism to get short, your stop losses can be limited to consequent encroachment and just a little bit above it. You know, what's a little bit above it? It would have to be, in my opinion, at least 3 to 4 handles above consequent encroachment. Because remember, we allow for what? Little mohawks, a little coloring outside the lines. And if you're too demanding and you want to have these 1.5 handle stop losses, which you can do on the lower time frames like the 15-second, 30-second, 1-minute charts, you can do that. But I wouldn't try to do that in the climate that we have right now because there's a whole lot of they've sped up things where it tends to be a little bit more exaggerated even when it's not moving much. It's still moving more than you're going to be comfortable doing with a less than 2 handle stop loss. It's just you're asking that it get stopped out. And are you going to have the experience to see the trade's still there and you were just being too greedy and too tight with your stop loss to get right back in? Chances are probably not. Where I can be stopped out, and you've seen me do it, I think 3 or 4 times this year. I'm trading with real money, live money, not demo, real money, getting stopped out, and immediately going right back in and getting what I wanted to take down as a haul. So that's experience. But you can't understand these things. If I was to teach it through a book, just only through a book with a static chart and then showing you after the fact, here's what it looks like, it wouldn't mean as much. You wouldn't be able to take from it the very impact that I'm trying to put forward in this discussion today. So seeing specific PD arrays, and it's not just simply a fair value gap that fails. There's many times I want PD arrays to fail. Think about when I'm teaching you order flow, and I'm talking real order flow. Real institutional order flow has nothing to do with level two data. It has nothing to do with a DOM, depth of market. It has nothing to do with volume profile. It has nothing to do with any of that gimmick. It has nothing literally to do with that. It's literally how every candle supports price. As it's going higher, every down close candle. In that down close candle, algorithmic buying is taking place. So it goes without saying, when it goes above that and it comes back down and touches it, it's not going to need to go back down in there because the algorithm has already extended the opportunity for the algorithms that use this in a marriage, like a handshaking between the delivery mechanism, the price engines that cause the fluctuations in price, and then the algorithms that can handshake with it, like my enigma, that my conceptual idea of how to handshake with the market's algorithm, they dovetail perfectly together. That's what makes my stuff precise. That's what gives me the confidence to share things on Twitter before it happens, and you watch it happen in your chart every single week for years now. 2 years you've watched it. Where my private mentorship, they've watched it for years, years, daily, every single day. This is what I think is going to happen, and over time you get comfortable with it. But when we see down close candles supporting price, what are we looking forward to on the opposite spectrum? When we're bullish on price, we want to see down close candles support price because they're acting as what? Bullish order blocks. But we want to see bullish candles on the other side, on the left side, that would be considered what? Bearish order blocks. As price was going lower, every up close candle should have offered what? Downside delivery, sell side delivery, moving lower. So we want to see price going through with ease up through them. That's real institutional order flow. There's no depth of market necessary. There's no fake ladders and spoofing that can occur in that. It's finite. It's in your chart. You can see it. Everybody has the highest high and the lowest low of every one of these candlesticks. Everybody that's looking at the NASDAQ futures contract, the same delivery contract month of December 2023, we all have the same high and low on that candle right there. There's no discrepancy. We all have that. We can see it's right there. Okay. You can't do that with Forex because everybody has their own Tom, Dick, and Harry spreads. And that's how it's not the gentleman's choice of markets. It was great when it was wild and woolly, and that's why I left futures to go over there because there was a lot of excitement and I knew I could do very well in short little time frames and capture big movements. But now we've had a little bit different dynamic. So I want to go back to what I trusted and where I started in 1992, which is the commodity and futures markets. And they're going to be much more precise and more refined. You're not going to see a whole lot of tomfoolery in it. It's very, very specific. You can make a career out of these one individual markets and not have to look at anything else. You got to figure out which Forex pair to worry about. No interest rate differentials to worry about. It's just, are we bullish or are we bearish? And where are we looking to go? Real simple. You can have a very short work life too, with 1 hour a day and you're done. And it's consistent. But when we look at PD arrays, and I was using the institutional order flow as an example. My point when saying all that was, when we're bullish, every down close candle should support price. Every time it touches it or goes into it, it should start repelling and setting price higher. And price should spool higher after doing so. If we have met a range extreme, or we traded to buy side liquidity that would constitute a potential reversal, while order flow has been bullish and we've maybe capitalized on that, Now, if we have seen a run on buy side and then it broke market structure and then rallied up and gave you a 2022 short entry, what do you think you would be expecting as the price is dropping down? Every one of those down close candles that supported price going up, you want to see price eat through that quickly with no hesitation. You want to see those down close candles when in the hands of anyone else, they're going to think that that's a bullish order block because they think every down close candle is an order block. And it's not. It's not. There's a narrative at work that you have to know what that is to make the order block be what you expect it to be in terms of a catalyst to be an entry or a target. Hello. So every PD array has in its formation a application of wanting to see it fail for the purposes of giving you insight, then you can use it for a counter trade idea. It has an inverse nature to it. So when you see price like this and you finally, and what I just said, for some of you that are brand new, you don't know what I'm talking about and you don't really appreciate what I just said. But for students that have been with me for a long time, they just had a light bulb moment because now all of a sudden they're like, wow, I don't have to worry about my model in the PD array like the breaker. If it fails, I can have an inversion and trade off of that. If I use a mitigation block and it fails, okay, when it trades back to it again, I can trade it inverse and capitalize even with half the leverage and get back what I lost and still find a profit. So there's no reason for you to fear or try to avoid losing because you're going to lose. You're going to have a losing trade. You will absolutely have a losing trade and probably have a series of them, especially when you're brand new. But there's nothing to fear. There's no reason for you to fear that because your ability to judge and pick the very specific entry points and measure the risk that's appropriate for you from your entry to where your risk is, that's a skill set that's going to take you a while to figure that out. I have rules that help you do that, but you still, like I talked about the Twitter space yesterday on my Twitter feed. I talked about where motivation becomes impulse. You have all these good intentions of going in and looking at the chart and maybe doing something that is highly organized and specific and disciplined. But when you get there and you're the excitement of maybe potentially missing it and then second guessing yourself and you think, well, what if my model isn't there, but I do see it moving up here and I think it's really going to go up above that old high or below that old low, and you completely abandon the model and you trade recklessly and impulsively. You won't do those things when you start seeing that this dynamic that is in price action. These things repeat all the time. They repeat all the time. And when your model fails you, based on whatever PD array that is that you're using as an instrument for entry, whenever that fails, just know that there's one of my students that were looking for that very PD array to fail because their model is returning back to it and then using that. Never looked at it like that way, have you? But that's exactly what some of my students do. They're not they're not breaking the models. They're not trading outside of what I taught. They're just using it in a model that fits their expectations on price at that given time. And it may not be an inversion fair value gap that you use as your model, but it gives you the flexibility to say, okay, I use fair value gaps to enter. But if I get it wrong, that means it's probably indicating that I'm really offside. So if it comes back up and trades back up into this level here, it might offer some measure of resistance. So therefore, we could see an opportunity for it to trade. And where would it trade to? Here's a daily low right there. What could you use as a partial before you get to that? Half of this range, which is what? Right here, which will be right below Friday's low. The opening of that candle and the consequent encroachment of the wick. Do you have to take a partial every single one of them? No. Which one would make sense for you based on how much you're leveraging, where you got in at, where the entry was? Because it could trade up to here and break extremely hard. And then the only first fair value gap it gives you would be down in here that you would feel comfortable taking. And there's a lot of things that you have to weigh out. And unfortunately, there isn't this always easy 1, 2, 3 criteria or recipe where it always does the same thing at the same manner, the same range in pips of risk, the same pips in terms of the profit, and every profit partial should be only this many pips away from where you got it. That doesn't, you can't do it that way and be consistently uniform. I wish it was like that, and I was trying very hard as a young man to make trading like that. And I've come to the conclusion it's not necessary. That's something that will evade you. That's perfection, and perfection's not necessary in profitable trading. That's an epiphany that once you get that, you don't have to be perfect to be profitable and to be content in that profitability, not thinking I didn't get enough, which is why I always preach what? Be content with enough. Do you have more money today than you had at the start of the day? If you do, stop. Go home in profit. Get used to feeling that. Who cares if it's only 50 bucks? Who cares if you just you covered the cost and commissions and you're not in a net loss for the day? Go home and feel what that feels like and grow comfortable saying, you know what? I didn't lose money today. Your first goal is to stay as a break even trader because most people go right out the gate, go straight down and lose. You don't want to do that. You want to be able to maintain that watermark of where you opened up your equity, that balance. You want to stay real close to that until you figure out who you are and what you're trying to trade with. You're going to discover a whole lot about yourself when you start trading with real money. When there's real risk, you're going to decide whether or not you can trade with that model, with that time frame, with that measure of risk, that number of handles or pips that you're trying to use as a stop loss. It might not be feasible. You might need to trade with a larger stop loss because your precision isn't there yet. And that's not a knock against you. That's not saying that you can't be more precise with smaller stop losses eventually. But so many of my students try so quickly to try to rush to these really small little tiny stop losses like that somehow makes you superior to someone else. It's not, because the chances of you getting stopped out exponentially increase. It demands precision that you may not have yet. Whereas someone that's brand new and they offer themselves a 15 handle stop loss, you know, that sounds like a lot. It is if you're trading with 15 contracts on a mini for S&P or NASDAQ. That is a lot. But you're not going to feel that way if you're trading with one micro lot. It's not going to be that much. And you have to learn how to manage yourself. You have to learn how to hold on to these trades and not freak out and be in a rush to get your stop to break even or profitable. That's an entirely different lesson you have to learn too. That can't be taught in a book. I can't teach you a lesson that makes you feel comfortable doing it. You have to follow the rules I've provided and then do it. And you'll discover, okay, I need more time doing this with a lot less leverage. And which is why I tell you go down with the micro. $5 per handle for the E-mini S&P and $2 per handle on the NASDAQ. That's not a lot of money, but you can still make money doing that and learning how to get good at it. So many of you get these funded accounts, like my son. He can get these funded accounts. He's made money with it, and he ran in there and tried to do a $150,000 account and dusted it quickly because he went back to doing big contracts again because he thought, well, all I gotta do is replicate what I did there with more contracts, and he found out he can't do it. The fluctuations of the money scares him. So if he's scared of the money, is he going to think about the trade, hold it correctly? No. 2 ticks or 3 ticks of movement against him, it scares him out of the trade. He closes it in a loss, and then it runs in where he's thinking it's going to go. And he does that multiple times, and eventually he hits the maximum loss, and then that 150 count is gone. He did that with 2 of them this week. You're not obligated to know that. But I'm telling you, just because he's my son, he's doing the same things that some of you probably are doing right now because you're impulsively trying to do things that you're not really ready to do with an amount of risk that's too high for you. You have to graduate into that. I don't know why I even brought that all that up, but just know that the stop losses, I would like to keep the stop loss tight here at just above consequent encroachment if it was a trade up to that level there. And if I got stopped out, it's okay because I'm following the rules of what I've outlined here. But because we've overlapped it and we went from the highest point, the consequent encroachment of the fair value gap, and the low, and went beyond it, and we closed below it here, if we open below this low and trade back up to that level there, I would expect it to act as resistance. And it could only, in my opinion, be high probability if it stayed below consequent encroachment or just 1 tick above it. And I would not want to see it trade to the high end of it. and still act as an inversion fair value gap to offer lower prices. That's how I'm framing it, so you know what I'm looking at, why I'm even factoring any interest around these specific levels. So now, because if we have something that forms and I point to something, whether it be hindsight, after the fact, throughout the week, you know that I've outlined the very things here. And if it doesn't work, it's great. You'll get to see what it's like to be here before the market opens up on a Sunday, where everything's completely random. You don't know where that opening price is going to be, and factoring all the other things I've talked about that's going on in the world that makes things a little bit more complicated and complex than it normally is. But you can still find opportunities, and this is how I would frame this for S&P. So 60-minute chart. What I just covered there, that would have been a charter level lesson. Only people that would have been at the charter level, and if other people were going through mentorship and haven't got to that point of being charter, they never would have heard that lesson. That would have only been for a charter member student. They just learned something that they just learned for the first time. Stop buying into people's mentorship saying that they're teaching something that I'm hiding away in some other chat room area. I'm not doing that. I'm not making videos for anyone because they're going to take them and sell them. I'm not creating a market for them, okay? So I just want you to understand that. All right, so this drop down outside of that gap closed in this portion of this buy side and sell side inefficiency. And if you look over here, this is a little too clean, and there's a gap right underneath it. So if you look at that, I like this. This inefficiency now has been repriced to with the movement to here. So that gap is only this candle's low to this candle's high. So that you would extend that to the right. And you thought I was just buying moving average crossovers. I did too. And it might seem like it's very, very complex right now, and it will be as a first introduction to it. But over time, seeing it utilized and referring back to the same logic, and it repeats. Every single week, it's the same stuff. So we have inefficiency below price, and we have the sell side below this low. That would be the draw. Should we move lower? If we move lower and then come back up and use this area here, and we haven't traded into the fair value gap down here, that would be from this level of the daily inversion fair value gap to as much as the midpoint, which is consequent encroachment. From those two levels there, or anything between it, trading down into that fair value gap, that would be a setup that I would like to trade this week. I would like to do that for ES. If it offers it to me, I will try to do it. And if I can manage to finesse it, or if I'm available in front of the charts when it was to happen, I'll record myself doing it, and it will be with a live account, so you can see it's real money, and you'll see that this is what I tried to do. I talked about it as a scenario, and this is what it looks like. Okay, you'll see a real stop loss. I don't trade without a stop loss like a maniac that thinks he's always right and then loses his ass in front of everybody on the live stream. Okay, I'm not trying to present perfection, but I'm trying to select very specific things that I feel are high probability, and I'm trying to engage them. That's what I talk about on Twitter. When I point to something, I have already come to the conclusion within myself that this is something that I think has high merit. It's worth mentioning. It means I feel confident that I'm probably not going to be wrong. There isn't a lot of times where I point to something, and there is even less instances where I talked about something on Twitter and it not pan out. The point of that is, how many times have I done that? It's not every single day, because every day is not everyday trading. Day trading is not everyday trading. In the beginning, you want it to be. You want to find an opportunity to do something every single day because you're excited. You want to make money. You think there's an opportunity for you as a brand new student, brand new participant in trading. You think that that's something that's realistic, and it's not. That's not. Someone that's versed in trading and understands price action, understands their model, and understands themselves, yeah, they can do that. They can have an everyday profitable experience. Might be met with some losing trades in intraday, but if they really know what they're doing, they can come out of that losing day, net loss day, and come back and cover costs and be very even, or maybe eke out a small profit, or If you're really, really good and the opportunities present themselves in the afternoon, in the last hour of trading, you could find yourself from a net loss day in the morning half, get back to break even on the PM session, and somehow find your way into profitability on the final hour trading. But that type of trading isn't what a neophyte or a new student should expect. You shouldn't expect to be able to do that in your first year of trading. And I'm being 100% practical and honest with you. Some of you have expectations placed upon yourself that are not realistic. And when you don't hit them, or you're able to, or not able to be able to do that in your trades, you feel that you're a failure. And it causes you to be impulsive and reckless. And then you do things that are outside your model because you're angry at yourself and you resent yourself. So you inflict punishment, but what you're really doing is in your mind, you're justifying why you're punishing yourself, but you're calling it punishing the market. I'm coming back with revenge. I'm going to take something from you. But really, subconsciously, what you're doing is you want to lose because you want to stop doing what you can't control yourself from doing. That's what a gambler does. I talked about this yesterday too. Gamblers, at some point, they get to this, it's called gambler's numbness, where you just bet for the purpose of just you want to lose, so that way you have nothing left to do because you can't control yourself. You can't get away from the table. You can't get away from the slot machine, the one-arm bandit, the jackpot machine that everybody that puts the money in, the poor man's casino's game. At some point, a gambler, whether they're trading or whether they're playing cards or at the casino, without seeing profitability, frustration kicks in. And normal person would say, okay, let me just cut my losses here and go have a dinner or watch a show and come back and try to do it tomorrow and see what I can get with it there. That would be mature. That would be someone with a good steward mindset with the money that they have in their hands. But most people that go to casinos don't have that. So what will happen is they'll keep gambling until they get to this point that's called gambler's numbness, where you don't care if you lose everything. In fact, subconsciously, that's exactly what you want, because your inability to leave the risk, to leave the losing, and get back to a sound mind, you're incapable of doing it. So you start offering the opportunity for everything that you have to be lost, which is the reason for you to stop, because you don't have a mechanism to stop yourself. That means you're undisciplined. And many of you probably have experienced that. Right now, you can look back and think, wow, that's exactly what I was doing. I never looked at it that way. But you're doomed to repeat it unless you identify that's exactly what it is. And if you get to the point where you're just pushing the button for the sake of pushing the button, you need to immediately get out of that trade, preserve what you have left, take the rest of the week off, period. There's no discussion about it. Don't look at my tweets, don't watch my videos, don't talk about trading, don't look at charts, stop for a week. You have to ground yourself. It's really important that you understand that that is something that will wreck you. And I see people that have been trading for a long time and they still do it. They can make money here and there, but they're not consistently profitable. They're not millionaires in trading, despite saying that they are. They fail consistently trying to do something that's outside their potential or outside their skill set. And they're gambling with the one chance that they might be able to pull it off, and then hoping that the public sees this and thinks that that's what they do all the time, when they don't. That's just an aberration. It's just one-time event. And they're treating their trading, over leveraging, doing more contracts than they can reasonably handle without a stop loss, because they want it to be right, so that way they can champion this whole thing. And that's not what trading should be. It should be about picking very specific entry points, having very controlled risk that's reasonable, and a profit objective that is handsome enough to know that it's worth taking that risk. And the precision of entry around the logic and the narrative of why that trade should be performing that manner, why price should deliver that way, where it should go, why should it reach for that objective. It can't be just milly-nilly and some Mickey Mouse logic. It has to be something of substance that's outside of retail logic. Because if it's retail logic, that's flawed. It has to be on the basis of a purpose of running for liquidity or rebalancing and repricing to an old inefficiency. That's the only two things that causes prices to go up or down. Apart from that, it's manual intervention, and you can't time manual intervention. You can expect it a specific week around calendar events, The economic calendar has a lot of big news reports or speeches, or the Fed chair comes out. Okay, yeah, manual intervention is likely to occur at that time and around that day. But there are other instances where manual intervention can come in and completely surprise everybody with an explosive price move that was exaggerated well beyond what would be reasonably expected. And if you're offside in that event, that's risk that you didn't foresee when you first started trading. And I'm trying to be practical and reminding all of you that's always looming. And it's really looming in Forex right now. So I just want to make sure you understand that. All right, let's finish this up so I can hear my wife down there banging the dishes around. She's letting me know she's getting frustrated. I'm on my way, baby. So we traded up, made a high here. We broke lower, had a shift in market structure, came back up to a bearish order block, rotated lower, took out another sell side liquidity pull here. just got inside. If you remember, I said I wanted to see it trade down into here. Go back and look at the old reviews on this YouTube channel. They're all time and date stamped. I can't time travel and go back and edit them. All right, so let's take this off here. So we went down in below that low here. It was a little too shallow for my liking. There is a gap. We traded up into that. The consequent encroachment of this wick, we'll highlight that. Okay, so we went above that just a little bit, Mohawk, then rejected there. So we did the effects of repricing to the fair value gap. This candle's low, this candle's high. So we repriced there, went up to the consequent encroachment of that wick, which is reasonable, it's expected. And we did bump the buy side above this short-term high. So those are all things I talked about on the hourly chart. When we get down to the hour chart, I'll show you what I mean in specific terms. But we went above there, and then we offered what? Sell side delivery, went lower. So now we have a couple things to look at on the downside. Should the equities move lower, these are the levels I'm going to be using going forward for this week. Consequent encroachment of this tail of this candle. I'm going to take this off, okay? So that way it keeps everything germane to what I'm referring to. So this is the first objective on the downside I would be interested in. I would like to see it reach for that. I want to see a daily close below this level right here. If I see a daily close below that level, I'm going to feel confident that we're going to run the relative equal lows here and dig down into deeper portions of this. What can we look for specifically in that range? Well, it's consequent encroachment or midpoint of that, which is 14,431 and 3/4. So that's a key level. So that will be on my notepad. This candle's low is going to be my notepad because it's an old fair value gap on the weekly. So it's a draw on liquidity always. It's always going to be a factor for wanting to reach and revert back to that. Even if it goes through it, I don't care. It's something to have in your charts, to have it in your notes that that level is going to be significant. It's salient to future price delivery for this week. It's in the realm of potential to revert back to it. And then the midpoint of this candlestick's wick, which is 14,777. Okay, so with those levels in mind, on the premium side, I wouldn't be so concerned about the high of last week, but I would be reframing the sell side imbalance, buy side efficiency here. So you would use these levels, the 13,356 and 3/4, which is the high of the SIBI, or sell side imbalance, buy side efficiency. Its consequent encroachment, which is 15,268 and 3/4. Is that right? Did I say that right? My eyes are not behaving like they should. Let me zoom in. 15,208.75. And then the low of the SIBI, which is 15,060.75. Okay, so it's this inefficiency here. So what we have down here is the discount, buy side balance, sell side inefficiency. And this is the premium because it's above where we closed. So what's above the closing price? This inefficiency. So I would like to see price stay at the lower portion of this SIBI, not come back up into this area here, not in the upper portion. But what happens if it does? What could we allow for, even though we don't want to really see it, but what could we allow for? We could allow for it to trade up into this week's consequent encroachment, which is here. So it's about the upper quadrant of this inefficiency. See that? This level here, which is half of this wick, is exactly approximately, I just coined a term, it's exactly approximately, that's pseudo precision, the upper quadrant of the SIBI. So let me shade that because this is what it would be acting as, bearish. So let's keep everything in germane color scheme. So we have 15,288.25. That's the worst case scenario on the upside. If we close above that on a daily chart, then to me, I'm on the sidelines. I'm not interested. I'm going to sit and wait. But as long as we remain below that and below consequent encroachment of the SIBI here, I would be expecting weakness or heaviness. And then when we get down to this level here, that would be the first objective for for profit taking or a partial. And then we have the old buy sign about sell sign efficiency, which is this candle's low. That would be a target. And then you have the relative equal lows here. So they're real tight within like very close proximity to each individual price. The low of that candle comes in at 86 even, and this one's at 89 even. So we're only talking about 3 handles. So there's sell side below that. And if we reach below it, it's not going to just be reaching below it by a little bit and come back up. It's going to reach below it and reach down to consequent encouragement and probably reprice down to the low at 14,244.5. So that's what I'm expecting going forward. The levels I'd be anticipating that would be impactful for the week. You see that here now. We'll drop into the daily chart. Okay, you can see how we worked up into this fair value gap here. No. Yes. Okay, we worked off that. Just a little bit of a contrast. Traded right up into the here, cleared the buy side. I actually talked about that very area in discussions last week. Go look at this stuff. Don't just take what I just said here and say, well, ICT said it, so I believe it. Go back and listen, and you'll see me specifically point to these. Is a little too clean. I like to see it trade up into that area here. It did it, bumped into it, and then what did it do? It behaved in a manner where it's seeking what? Discount. Sold off. Small little fair value gap in here, which it went through. What are you thinking? What are you thinking? Right there. We traded right through this small little inefficiency. Right there. What do you think that might offer us? It's not guaranteed, but what would you consider that to be? I used white so that way it wouldn't remind you because of the color. Inversion fair value gap. So if we gap lower down here and we trade back up to this area here, I would like to see it trade to and as much as what? The high. Why? Because we only have the high of the fair value gap. Nothing else went through it except for this one single pass. So in this instance, we can allow for it to completely trade back to, through, and have a mohawk, and that's completely permissible. And then we'll see if it offers resistance there and see if it wants to trade down below this candle's low. That will be a new objective because there's sell side below that candle's low. It's a daily low. And then we would look for it to reach down into the sell side below here. But prior to that, where else could you expect to see a partial if you were bearish? And you're just learning and you don't want to hold on to something that needs to go through all this price action here because it could go down into this area, bounce back up to the low of that, and might scare you. What could you reach for? Consequent encroachment of this wick. It can go down to there and come all the way back up to this level here and then break lower. So when you have these balanced price ranges of back and forth price action like that, remember it takes a lot to rip right through that unless it's extremely heavy and it's being powered through with a lot of other factors behind it. But we might not get that this week. So it's important to know where you want to take your partials, which would be below this low here, consequent encroachment here, and it could come back up, trade to this one here, or just a little bit below it, not take these lows out, come right back up and trade into the consequent encroachment of this. Trade right back to that, and then at a later time take out the sell side. That's what makes trading with a high resistance liquidity run, which is trading through these types of consolidations. You have to be able to pick where it's reasonable for you to take partials. So I'm tipping my hand then to you because you've spent the time here. So I'm kind of rewarding your patience listening to this. The trades that I take partials on are the ones that I'm trading inside of a high resistance liquidity run. If I'm trading on a low resistance liquidity run signature, I'm not taking any partials. They're full pulls. That means whatever I get in at, I'm picking my target and I'm just letting it go. High resistance liquidity runs are still likely to pan out and my targets could still be met, but I don't know for certain if it's going to happen during a session I'm willing to sit in front of the charts So I have to pick out where my partials are, where I know I have a time. My day is scheduled. It may not seem like that right now because my wife's down there, probably pissed off because I'm a little bit longer than I want. But she knows that it's likely to happen, and that's why it needs to stop in the 11th of November. So she's being very, very patient. She probably already started eating without me, actually. She'll probably hit me with a grape when I go down there. But knowing the likelihood of the market presenting a reluctance to get through a balanced price range, what makes this a balanced price range, by the way? The prices offered sell side, buy side, sell side, buy side, and it left the range, all this consolidation. So it takes a more meaningful move to get through all that, and it generally doesn't happen in one single pass. So what I like to do is I like to break that range up into where it's reasonable and where it's logical for the market to at least trade to the midpoint of that wick. That could be the first target to take a partial if you're bearish. The low of that candle, the consequent encroachment of this wick. And it need not take the lows out here to still be profitable. And then down here, I expect it to try to do some kind of fake thing where it trades to this level, doesn't quite get down there yet, and maybe come back up to consequent encroachment of this wick or the low of it, and then move lower. Doesn't have to do that, but I make allowance for that when I'm trading against high resistance liquidity runs. But low resistance liquidity runs, I don't have any partials in. I'll stake my entire trade on the initial entry, and my stop, I'll just manage it to where I can take the risk away, and then once it's removed, I just let it go. Because my conviction behind the analysis and the trade is that it's more probable that it's going to go where I think it's going to go, and not need for me to scale off anything because it might have a retracement that's deeper than I'm willing to accept or be able to manage, because I can't be in front of the charts because I've scheduled this much time for my day to do this, and I have other places to be, other things to take care of, or requirements from my family. So that's that. And let's go over real quick though. Any gap lower opening at Sunday in a little while here in about 3 hours. The drop below this in an opening, if it does that, we can see it trade back up here and all the way back to the top of the fair value gap, because it's only had one pass through and nothing else has happened since the formation of the fair value gap. So very critical rule-based idea when it comes to trading with inversion fair value gaps. The rule-based idea is very specific. It's not complicated. You know exactly when to anticipate certain ones to stay open now, when to anticipate when they are going to completely fill in. When is it best case scenario for it to go halfway? You now have got that information now. So when I talk about it in my book, you'll see this video being prompted to you as a amplification of what I just mentioned about trading inversion fair value gaps. Okay, no cost. You don't need to buy my book. Okay, I just explained it here. All right, so let's go over to what kind of guy writes a book and tells everybody not to buy it? A guy that's already rich and doesn't need the money. All right, so we go over here and look at the sell side here, and there's a buy side imbalance still remaining there. So initially the imbalance starts here to here. Okay, so it looks very similar to what we were outlining on the ES. So that's this. Okay, and because in this imbalance we had all this price delivery down, so the only remaining portion of inefficiency for sell side, because it's buy side imbalance, it's inefficient for sell side, but look at all these candles we went down in. So this level here on this candle's low to this candle's high, this is the remaining inefficiency. It's lacking sell side delivery. That means movement lower by price. So the way you use that information is below this low is sell side, and the inefficiency is here. So the market could draw down into this. These two PD arrays are discount by nature, and that's what I expect to see at some point. I'd like to see a framework that would allow me to see this inversion fair value gap, to see a trade entry, and then reach down there. That would be something I would like to do. That's really, really what I'd like to do. But how we open, if we open relatively unchanged, I'm not going to be so, fever pitched to get short at that inversion fair value gap. I may elect to see it trade there, start to move lower, create an imbalance, a fair value gap on a lower time frame, trade into the fair value gap, and then use these areas down here as the draw for my trade. So what did I just give you? Not a plan A, plan B. I gave you very specific things. If it does this, I will do that. If it does that thing, I will do that. I'm not going long. Did you hear anything about going long? No. So it's not plan A, plan B. I gave you two scenarios that I feel confident that if I get them, I will sell short NASDAQ. I will sell short with a live account. I will make money with a live account trading these setups because I believe this is what's being framed. Okay. I'm not saying that you should take these trades. I'm just saying that I'm willing to do it. If I'm in front of the charts and if that materializes at the time I'm looking at it, I will use this framework to take that trade. That is not a trade signal. That is not an invitation for you to follow me. It's not for you to take it on your own. It's not for you to trade your combine. It's not for you to trade your funded account. It's not for you to try to demo trade it or here because I don't want you taking it in some way, twisting and contorting it. I'm just telling you how I see, but we did that right after the dollar index. So if you found this today, counseled you and helping trader or someone that is already profitable but just finds their way into some kind of you know, hope you're all doing very well. I'm going to ask you if you would please give me your heads up. Let me know how much for that. Family members visiting here today. So, all right. So last weekend on Sunday, before we had the market open up, I mentioned that I was not willing to take anything as a trade unless it was to show me a move on the daily chart with a close above this wick's upper quadrant, which is right in here. Okay, so you can see we never even got up there. So Monday, Tuesday, Wednesday, Thursday, no interest, no concern, nothing. And I mentioned last week that I'm content with that if it were the case. But I'll show you when we get into the NASDAQ what was obvious and what was something I actually executed on, and you can see that recording on my Twitter feed. But you can see we didn't have that. We had an inside week. So that is, I'm going to take this measurement off here so that way you can see it's no longer necessary here. But I'm still interested to see it try to get above that level. And then we have this wick here. We can measure it like this. So you want to have 105.774. Oops, I'm sorry. There you go. 105.818. That's consequent encroachment. So if we were to have some one more time drop down in to revisit this inefficiency rate in here, you'll see it more plainly when I remove the fib. But that is consequent encroachment of that candlestick's tail or wick. So if we do get some weakness, that would be a area I would watch, and I would want to see it support that. It's better in that it doesn't do it because I'm trying not to pick a top on the dollar index with all the things going on around the world. I don't think that we're done yet with it going higher, but I'm completely comfortable with being proven wrong. So I'm going to put these levels back as they were, and when we drop down into a daily chart, you'll see what that is. But that inefficiency rate in here with consequent encroachment of this wick, they overlap together, so that's a convergence between two discount arrays. I'll put that back on here now. And we'll go into a daily chart. And if you recall, and you have the benefit of going back and watching the recording that I live streamed last week, I mentioned this fair value gap here that's shaded. I'm going to color it just a little bit differently so that way it really stands out. I said that we could draw down into that level, but I don't think just because we go down that, I'm not long dollar if it does that, meaning that it would be shorts forming in euro and cable. Go back and listen to the live stream last week, and you'll hear me say those very things. I would want to still see it want to go higher first to the upper quadrant of that weekly candlesticks wick that I mentioned before we drop down to the daily chart. So notice what happened last week. We had Friday, Thursday, Wednesday, Tuesday, Monday. We spent a lot of time down in this gap. So between this candle's high, this candle right here, this candle's low, that's what's being highlighted. So this is a buy side imbalance, sell side inefficiency. It's a fair value gap by classification, but specifically because it's an up close candle, that means it's a BISI, B-I-S-I. And it spent a lot of time in that. The last week commentary, I mentioned how I was placing a limit on my interest in filtering how much interest I can have in the marketplace. So in other words, it had to meet a specific criteria before I would take a trade. And I went the entirety of the week until we got to Friday. And then finally I saw something on NASDAQ that I was willing to take. But by far and large, my caution last week, I was rewarded with that through the entirety of the week because, as you can see here, it really wasn't doing a whole lot in terms of movement. We dropped down to a 4-hour chart on dollar. I'm going to try to get through this because I want to be with you live with the opening here in about 24 minutes. So here's that daily box and balance, sell side efficiency. And you see we spent most of the time here. Look at the bodies of the candles respecting halfway or consequent encroachment of that blue shaded area. See that? So they were taking it lower, and this one here went one more time down into it, and then we're just meandering around. So do we go lower? I don't know. I don't know if we're going to do that because it's Sunday. I mentioned this many times before. Sunday is it's a gamble. I don't know how to predict the opening price on the new week, so I have to sit and wait like anybody else, and determine what they do from the opening price. So we'll get a new week opening gap. We can see what we see from there going into Sunday, Monday, London Open, New York Open, and how we trade on Monday. So yeah, let's go into a hourly chart. You can see how we were pretty much just going sideways all week. So here's Friday's trading, Thursday, Wednesday, Tuesday. That in relationship to the euro dollar. Euro dollar failed to make a lower low at the shaded area, which is opening. Maybe come down, try to fill it, then rush to go higher. That's what I would like to see. It would support the idea of not trying to pick a top on the dollar. It would also confirm what I've outlined on Friday when I was in my trade, but I don't want to carry anything over the weekend because of gap risk. And I didn't notice a whole lot of things happening overseas that would cause a lot of excitement. Of course, I don't have the intel that would be in northern Gaza right now. So whatever's going on up there, it's kind of like a media blackout. So whatever may be happening, we may find out later this week. But all eyes are on Middle East, and there's a lot of concern about that, and that is being factored in and built in, wrapped up into sentiment for the marketplace, and none of it's favorable for risk on. And I think if anything happens this week that is seen as a rally in risk, meaning like euro dollar, pound dollar, NASDAQ, or any of the indices or stocks, if they go higher, I think they're going higher to be faded. That would be my expectation. They would be short-lived and then be met with more shorting. But the dollar index has to start showing me a little bit more in here because the fact that it's being consolidated and held in a range like this isn't as helpful because all that does is allow the crosses, for instance, like the euro pound and the Aussie New Zealand, those exotic pairs that are not coupled with dollar. When dollar's in consolidation like that, that's when those unrelated dollar-based forex pairs are permitted to move around freely, and they have exaggerated moves, and it's based on its interest rate differential. So the stronger will move better than the weaker, and the weaker will move softer than the stronger. So when dollars in consolidation as a forex trader, you want to be thinking about, okay, then I need to look at the relationships between the interest rate. So the interest rates between the two currencies that make up a pair, if they're paired together, and they have to be a pair that's not with the dollar index. So since they're since the central bank's holding dollar in consolidation, you have to take your attention away from the majors and look at uh, the exotics, anything that doesn't have a dollar associated with the pair. And then whichever one's stronger versus the weakest, if you compare those two up, that's where the bigger moves are going to occur. If you look at last week's trading, yeah, I taught this in core content too. It's all on my YouTube channel for free. But I'm just reminding you all, because I know a lot of you are predominantly forex traders, and most of my students are forex traders. Don't lose sight of whenever the market is doing this in dollar, if it's consolidating, your mind should be not trying to trade those dollar-based currencies. Start looking at the exotic crosses. And like I said, I want to see it. I would rather see it open gap higher, trade down, and then rally and start moving for the buy side in here and above here, over here at these highs. All right, let's take it on into euro dollar. Here's euro, its weekly chart. And in similar fashion, we had an inside week last week here. So an inside week, I failed to mention it earlier when I was talking about the dollar index. An inside candle or inside range, inside bar, inside weekly range means that the week that we closed, its low, I'm sorry, its high is lower than the previous week's high, and its low is higher than the previous week's low. So that means it's usually an indication that there's going to be a large move very shortly, usually within the next two candles. I like to anticipate the very next candle. That would be like this current week that we're opening up here in about 17 minutes or so. Um, when that market opens, or when this weekly market opens, I would expect the beginning of a large weekly range. Now, we may not get it this week. It may be deferred one more week, but usually it doesn't make you wait longer than two time frames. So since I'm utilizing the weekly chart here as I'm discussing this, the expectation would be that we expect to see a large range weekly candle. Now, by in and of itself, it doesn't give you a directional prognostication. It just tells you the magnitude of the move. Okay, in other words, how much energy should be shown in price delivery. So you're still required to have some measure of prognostication behind the direction. Are you bullish or are you bearish? So if you have an inside range or inside candlestick or bar, it's usually the very next candle or the next candle after it. So inside candles or inside ranges has a lower high than the previous range and a higher low than the previous range. And all that means is it's compressing. And we expect range expansion, large ranges to come to fruition. Now, if we don't get it, this is for your notes, if you don't get it after two, like say for instance, we're looking at the weekly chart, if we don't get it this week or next week and it's still range bound, then that usually implies that it's going to consolidate longer, to not anticipate a large range move. So it's kind of like, you got to balance these things out and take from it what you can. But I like to anticipate the very next candle to be a large range expansion or the very next one. And then if it doesn't give it to me, then I go right into scalping, and I'm not looking for like a one shot, one kill scenario, which is what I would favor in these conditions where we're expecting a large range move on the weekly. That would be great for the series of the daily chart, creating one-sidedness predominantly over the course of the week. So between Monday's trading and Friday's close, I would expect more directional trading given the context that I'm showing you here. Okay, and I've already showed and told you that I favor a higher dollar. That's what I favor. But what I see here at the open with you in a couple of minutes, I'm going to get through this. That will help me decide what I would like to see going into London tonight and then going into New York tomorrow. So I'll kind of like talk over that as we see what the market's doing at the opening. All right, so daily chart. Okay, range bound in here. We did come down into this candle right here on Wednesday and Thursday and just found a little bit of support in here. I'm not terribly bullish. Like I said, I'd like to see this showing willingness to want to gap lower, opening, and then trade up, fill it, and then work towards moving lower. That's what I'd like to see. Because I'd like to see it doesn't mean that it has to do it. I'm not trying to impose my will on it. But if it does that, then it gives me a lot of confidence going into Monday to anticipate further weakness. That's what I would look for. Doesn't mean I'm going to try to trade on Monday. It just means that that would be supporting the idea that I expected going into Friday's close last week when I was short NQ. Now, if I'm wrong, say we gap higher, we trade down, then I would look for a move on the first half of the week to try to trade up into this area here. And if it fails to do that, then we would resume weakness. But I don't necessarily see that as something I would trade. I wouldn't go long based on that. I still favor shorts, and until proven otherwise or incorrect, and I'm welcoming that opportunity to be proven incorrect. I want to see evidence to support the idea that I'm wrong, and if it gives me that insight, it costs me nothing to get it. Number one, I'm not risking anything because I'm giving you my expectations technically, but I don't have any hardline risk behind it. So I'm still in that intel state where I'm trying to get information and insight from the marketplace risk free. And then once I get a determination of what I think it may be trying to do this week, that's high probability, then and only then I'd be willing to take some kind of a trade or start calling things out on Twitter again live. All right, so 4-hour chart. Let's try to get through this a little bit because we're running out of time here. This is really, it's not a market that is, in my opinion, symmetrical, meaning that the price swings are really obvious. They're running for clear liquidity inefficiencies and then going to another obvious one. It's just doing very much the same thing we saw in the dollar index, just marking time, small ranges, a lot of back and forth price action. Can I trade that? Yes. Can some of my students, can they trade on the lower time frames? Yes. But these are the conditions that I try to teach new students to avoid because there's better markets and better market conditions to trade. And you shouldn't be trying to risk anything in these types of conditions because you don't have the experience to be able to navigate it well. You'll think that the moves are going to continue and they won't. They'll pull back in the range and retrace, either stop you out or scare you if you don't use a stop loss and you start drawing down your account. And if you read the comments on Twitter, there's a number of people that got beat up last week because they still tried to do something. I was recommending that, well, not recommending, but I was suggesting I wasn't interested in taking anything last week going into the week unless it did specific things. It didn't do it. So 60-minute chart. Again, this is ugly price action in here. Don't like that. I don't like the fact that they left this even. There's some gaps down here. There's liquidity here. So there's sell side here, inefficiency down here. I like the fact that we've taken this buy side. So we mark that out real quick. I don't want to get too wrapped up in the annotations, but we ran it here one more time in here. Again, I'd like to see a gap opening lower, come back, fill the gap, trade for the sell side here, and trade for the sell side here. That's how I'd like to see going into tonight, going into Monday's trading. That's the extent of what I have right now going forward on Euro. Cable or pound dollar. This is our weekly chart here. This one here, just not all that excited about it. But longer term, I'd like to see it trade down here, as I was mentioning last week. Sell side resides in here. We have an inefficiency with an order block. So if we get animated on the downside and continuation up on the dollar index, again, this is where I'm looking down here. We do have a sell side imbalance, buy side inefficiency in the form of this candle's low, this candle's high, that single down closed candle. We trade up into consequent encroachment here 2 weeks ago, and then we had not an inside range. We had a lower low on the week than the previous week, but we found support in this area down in here. Okay, and I mentioned that that would act, and we'll see it on the daily chart now. I'd like to see it get below that and act as an inversion fair value gap. I think I'm correct in saying it that way, but don't take my word for it. Go back and listen to last Sunday's live stream. It's part of the 2023 mentorship commentary. So this inefficiency, we went through it again here, and I want to see it go down below it and then treat it as resistance, and then move lower into those weekly objectives down here. Okay, so that's what I'm looking at for the daily time frame for pound dollar. And let's do on the 4-hour chart real quick. All right, so we've taken sell side here. The bodies were respecting that fair value gap. This is just really ugly price action. I really would not touch cable here. It would have to do something really animated to the downside before I would participate in this one. So just know that while I have co-signed and said what I'd like to see it do, directional, and where it would draw to for my analysis, I wouldn't touch this one. I would be more inclined to trade the euro if the dollar index were to resume going higher this week. That might change in the beginning of the week if I start seeing something different, or if I see something at the opening here in a couple of minutes, it might change that opinion. But right now, I would favor euro over cable for the week. And you can just see just really sloppy, really not a good week at all to be trading cable if you don't know what you're doing. All right, and now let's get into index futures, because that's where we're at really in this mentorship this year. And I know some of you don't like that because you want me to do just Forex, but you got to get what you can get, right? Everything's the same. Price action's the same regardless of what asset class. So here's the quarterly shift target I was talking about months ago, and we were up here trading. We broke down, and then last week we had a really nice sell-off in here. Obviously, there's relative equal lows here, so there's sell side below that, and then we have the consequent encroachment of this range right here. So we have midpoint, which is 14,431 3/4. I'd like that level. I like to see it trade down in there, but initially we got to see how and if we get below these relative equal lows. There's sell side resting below that. I mean sell stops. So it looks like it's in a hurry to get down there. It resumed off of this sell side imbalance, buy side inefficiency between this candle's low, this candle's high, traded up into that there, and then rejected that. Overshot the consequent encroachment of this wick, but it went into the upper quadrant. We'll take a look at that real quick. It just fell short of that. I thought for sure it looked like it hit that, but got real close to it. Went to mean trash. Consequent encroachment of this inefficiency of the wick. We treat that the same way as any other gap traded there, and then aggressively moved lower. So I want to see it gap lower than when we closed, and then rush underneath these lows and accelerate down into here. That's what I want to see. Doesn't mean it's going to happen, but that's what I would like to see happen. And it's not meant for you to be taking this as trade advice.
best thing that can happen is for me to get it wrong, and you can see how I would navigate the rest of the week with that insight. So again, sell side resting below here, got real close into it here. It makes perfect sense for it to be gapping down there below it. And then if it does gap below that and we start to come back up, we'd have to see it respect this inefficiency right in here. It would have to stay below specifically that low, but it can spike up to consequent encroachment of this wick. Okay. And I would like to see it stop there because in this case, it would be consequent encroachment of this fair value gap. Then we have the consequent encroachment of this wick. And I wouldn't even look at this volume imbalance because I want to see this volume imbalance act as a breakaway gap. Okay, so I want to see it gap open lower and show a willingness to want to keep going moving lower. All right, and again, sell side in here. Just really ugly price action all through here, and finally broke down, gave a nice continuation with a market maker sell model, which I'll amplify on the 4-hour chart of NASDAQ because that's the one I operated on. And then we have a bearish order block in here. Market again reaching for sell side. 60-minute chart. I have 4.5 minutes here. Sell side imbalance, buy side efficiency here. Trade up into the breaker, which is high, low, higher high. There's the low in the middle. Trades up into it here. Leaves a small portion open. That's exceedingly bearish. I like to see that. And then we had that nice sell-off in the afternoon on Friday. So we'll be looking for that to continue. And now finally making our way over to NASDAQ. I won't be talking about gold, but I will comment it tomorrow during the New York session on Twitter. So if you're interested in knowing all the business there, and you obviously see that there. So weekly. Again, down here is my quarterly shift objective. People were getting real excited previous week. Oh, it's going to keep going higher. And then we got this. So it's unfortunate for the folks that like to fade me. But the consequent encroachment of this buy side imbalance, sell side efficiency, and sell side here, I expect to see it draw in. I'd like to see it draw here this week. But again, that's what I want. Doesn't mean it's going to have to do it. But we did work up into this old inefficiency that's shaded here. So we trade up into that, and then here is this wick. There, we got above consequent encroachment and just fell short of the upper quadrant, which it could have spiked to, would have been just outside that fair value gap in the form of a civvy. So that would have been an allowance for that. Take this off. And daily. Obvious sell side resting down here. Again, I want to see this gap open below here. That's what I'd like to see. I want to see it open right below that blue line right there. And if it opens relatively unchanged, then that means we might have to roll up here a little bit and then resume lower. That's how I would expect that. How far up into this? I would use this consequent encroachment. There. So 757, that would be on our level. So if we open relatively unchanged or above the close, then I would look for it to trade here and then resume lower. That's how I'd treat that. But I'm preferring to see openings below here to take it right into that liquidity for the folks that didn't get a chance to hold over the weekend. They would be upset. Like I would have been at 20 years old, not holding over the weekend because I would have missed out on that really profitable exit. But 50,000, 51,000 is pretty good for a couple hours. So anyway, looking at the 4-hour chart here. This is a market maker sell model. So original consolidation. I walked you through this on the Twitter space. Came back, touched, and revisited the original consolidation here. So it's accumulation, reaccumulation, smart money reversal, low risk sell, first stage distribution, second stage redistribution. But right in here, I saw that it was not willing or hasn't yet gone below the original consolidation out here where sell side is. So in about a minute and a half, it's going to open up. So right in here, inside this inefficiency, that's what I was utilizing. So I would have liked to see it trade back up into this inefficiency and treat that as an area to use as an inversion fair value gap, but it was unwilling to get there. So when we drop down into a 60-minute chart, in here, we're trading up in here and failed to get into that 4-hour old buy side about sell side efficiency that I wanted to see act as an inversion fair value gap. It never got there. And even though it has a relative equal lows here, I'm not worried about that because the liquidity below here, which is based on that larger 4-hour area of liquidity here, that to me is a better draw than this will be. And it's going to be, in my opinion, in a hurry to get down below these lows over here, more so than this to come back up here to get to that. Because it's already done a lot of give and take back and forth. So I favored that in the 15-minute time frame. You can see that is what I worked. Oh, you got a slightly open gap higher. So that's not what I wanted to see. So, and in fact, I actually did a better job of managing the trade on Friday by closing it, by trailing the stop loss real tight and letting it take me out of the marketplace. So this is, again, what I was kind of open up with the commentary. I didn't see anything that was so troubling or worrisome that would have caused a lot of excitement. So I wanted to see how we opened because there wasn't anything, you know, all of it's bad. Okay, I got to be careful how I say this because I'm sure I'm going to hurt somebody's feelings, and it's not intended to be that way. But nothing is grossly exaggerated. Like I'm expecting things to get worse over there, and because of that, that's going to have reverberations in the marketplace. But because I didn't see anything on the news wires, and nobody I know of that is living over there reporting anything, you know, much more than what we've already anticipated seeing. So there wasn't a larger acceleration to the downside. So do I subscribe to going for a run higher? I'd like to see it shake off this opening gap, break lower, and still go down for the sell side. That's what I'd like to see. Once it gets down and below here, and barring any kind of, you know, unexpected event that would cause a lot of people to get freaked out, um, it could trade down below the sell side here, and then if nothing increases in the excitement or turmoil that's going on over there in the saber rattling and the war stuff that's going on, it could take the sell side here and then go all the way back up to here and reach for the buy side. That's what I would look for if we don't see escalation. So if we see escalation in the wartime things that are going over in Israel and Gaza, then I expect it to resume going lower. If we don't see escalation, I gotta make sure I said that right because I'm doing it live. No escalation, we'll eventually run back up into this the first 2 days of the week. If we escalate, this will stay in place and we'll just keep going lower. Okay, so hopefully that kind of makes a little bit of sense. So because of all the things that are going on, I take a lot of consideration for what's going on. Anything war related, anything that is, um, you know, violence related, those are a different market condition entirely versus, you know, an interest rate expectation or bad economy things. That's something that, I'm not too concerned about that. I'll trade ahead of things and not be afraid of, the underlying risks with it. But these types of events where you don't know how bad things can just pop off and do something, unexpected, and it'll happen when you're not expecting it in a time of the day when it wouldn't usually move big. That's usually how it happens. So that's why I've been counseling all of you that are listening to me and hang on like every word I say. You have to be really, really careful right now. Try not to be getting home runs. Trade with the smallest leverage. Use a stop loss. But in here, you can see we have this high, that low, and that high. That makes this down close candle my bearish breaker right here. Because all of this movement hadn't yet taken the sell side, which I was aiming for. And I still believe it's still a viable objective. I've not abandoned that, even though we had this really uneventful opening price here. We trade right back up into it here. You can see that candle has my two entries here, right in here. So it went up, hit it, came back off, and I got filled there. And then I added more in here and ultimately watch me get stopped with the trailed stop loss right there. So I was leaving it there in case we got this big runoff acceleration down into the sell side on Friday, which admittedly I was kind of expecting that, but it didn't come to fruition. So but that's okay. But that's a nice little run. Nothing else to speak of for the week, but using the information and the logic based on that 4-hour market maker sell model, which incidentally is my last model for this YouTube channel. I will be teaching it, I will be sharing it on October 31st at 9 p.m. New York local time. So that will be the last educational material that will close out my 2023 mentorship on the YouTube channel. It'll close out all of the instructional portion. It doesn't mean I won't do live streams. It doesn't mean I won't do market review between now and November 10th. It just means that there won't be any formalized structured lectures or teachings after that one. It kind of like closes this chapter in Inner Circle Trader for YouTube and Twitter. So that will be it for today. Hopefully you found this insightful. I want you to be careful going into this week. Try not to do too much. Pick your shots. Be very, very nimble. Do not risk a lot and don't over leverage. And until I talk to you tomorrow, Lord willing, be safe. Welcome back, folks. This is the last teaching lecture on the Inner Circle Trader YouTube channel. Before I get into this one, just to let you know that this is one of the closest viewpoints to how I actually trade. Now, when I say that, don't gloss over it thinking, well, that's all well and good. What does that mean? It means that you have to understand all the PD arrays. You have to be familiar with them, because what you may or may not realize is a market maker model is relying on your understanding of every PD array I've made available. So if you're looking at price, you're going to see things in price that are going to be salient to your understanding. If you don't know what a breaker is, if you don't know what a mitigation block is, if you don't know what a inversion fair value gap is, the observation of seeing it real time as a market maker buy or sell model may escape you at the time when you're looking at price action live. So one of the things I've seen throughout teaching this is that some of my students can see a market maker model really, really quick. And it's because they have been familiar with a multitude of PD arrays, not just simply an order block or a breaker. So they can see things and have a better understanding about price action. And that's what I mean by graduating in your understanding and not rushing this. So while this is the last model I'm teaching publicly, I guess the disclaimer going in should be that this is going to be very difficult for a lot of you. And I'm not going to sugarcoat that. When I taught my private mentorship students, I told them that these are things that are going to require you to know all the things that I taught in mentorship. There's going to be multitudes of market maker sell and buy models that are going to escape you. You won't see them until after the fact. But don't discount that as wasted opportunity. Log them, journal them, mark them up, okay? And then annotate them in a way where it looks like you've seen it coming, and journal it just like that. So that way when you look at your journal, it'll be in your own words that you saw it coming. It's all pseudo experience. It's conditioning your brain to see it as a positive thing. So that way when you see it again, it's a rewarding experience. And your subconscious is not trying to distract you from a painful experience. Whereas if you don't journal and you only have bad experiences by trying to trade with real money or try to do something where incurred risk is real versus trying to read price action and there's no monetary risk or gain, there's no ego, there's no pride, there's no pain. All these things are going to help getting you closer to understanding a market maker model. But for the sake of brevity, everything I disclose in this teaching, just reverse it for a market maker buy model, okay? Because I'm going to focus primarily on a market maker sell model. Everything here is shown in reverse if you are applying it to a market maker buy model. Now, I do have lectures and teachings on this in the YouTube channel, so this isn't meant to be a be-all end-all. I'm leaning on the assumptions that you have already studied a lot of the things I'm going to talk about. So if this is one of the first videos you've ever watched by me, or if you're a relatively new student, this is probably going to go over your head, and that's a normal thing. Okay, it would be considered a little advanced, and that's why I'm saying it's the closest thing to how I internalize price action when I'm engaging it. So 99% of the time when I'm taking a trade, it's usually something like this. That's the framework behind it. Okay, and I may or may not have the time or interest even to disclose the model that I'm actually trading inside of. That would be the market maker buy or sell model. But when you look at it conceptually, you can fragmentize these price swings and make one segment of the market maker model, whether it be a buy or sell model, and that in itself may be your unique model that you trade. Not that you're trying to trade the bottom of a market maker buy model to the top, or vice versa for a sell. It's a matter of preference what you want to do, because there's a buy and sell curve, buy side of the curve and the sell side of the curve, and we'll discuss that in here now. But this teaching is my market maker models. It's algorithmic price delivery and institutional price swings. All right, so I guess in a lot of ways, this is just basically my interpretation and creating a language around swing trading. Now, when I say swing trading, what I'm referring to is if I'm bullish, I'm trading from discount to premium, riding the coattails of buy-side delivery. If I'm bearish, I'm trading from premium to discount, riding the coattails of sell-side delivery. Now, when I mention buy-side and sell-side, you're thinking liquidity. And I'm going to draw a distinction between the liquidity and the delivery. All right, so imagine, if you will, that you were looking at price and those relative equal highs right here that we're looking at conceptually, we would anticipate a run above that. Now, if you can get that far in your understanding from what I've taught, you have the beginning building blocks of understanding how to look for a market maker sell model. But I want to flesh this out a little bit, because it's not just simply understanding where relative equal highs and relative equal lows are. You have to understand what the market's trying to do and gravitate to. And for the premise of doing it to go higher, longer term, or to go up just to trick people into being long and then going lower longer term. That's narrative. So that's going to be outside the scope of this teaching. So again, it's going to be very frustrating for you if you think this is going to be like a really elementary model, like the Silver Bullet, which is relatively simple, or Model 2022, which is relatively simple. This one's going to have a whole lot of talking in it, because I'm reminding you of the things that are going to be supportive for you to understand how to trade these things. If you're trying to trade like me, you're going to have to learn to do what I'm talking about here. If you're not inspired to try to trade like me and you just want to trade a Silver Bullet or a Model 2022, and that's all that you're interested in, and you're content with being successful with that, wonderful. You do not need to have this level of understanding. It is helpful to try to look at price action every day, every week, every month, and go through and see if you can find these types of models in price action. And by collecting them, you'll have a better understanding of what they look like in the future, because you've seen lots of examples of it that you've ferreted out of price action, not me pointing to it or someone else pointing to it after the fact. You want to be able to do this on your own. But for the sake of this discussion, the understanding is we should be able to see those relative equal highs, and that being this here and this here. Now I'm using a close line chart, so it's going to be a rather crude depiction of a general idea. Okay, we'll transition to actual charts in a moment, but for now, I want you to just think conceptually how if the market's going to run eventually up above that, and if we could hold a bearish stance, meaning that we look at every rally as a suspect rally if we're bearish, and then we're going to be looking for some measure of reversal, and then once that reversal is qualified, that meets the criteria for a market maker sell model, then we can go in and engage it. Now, an advanced interpretation of this would be anticipating the run above these relative equal highs here and being long prior to it. And the most advanced form of it would be to buy it during the buy side of the curve and then short it during the sell side of the curve. That is very advanced. And while I do have students that can do that like me, not many of them can. They can either trade the long side of the buy side of the curve or they can sell short on the sell side of the curve. So it's a matter of them picking what they can see clearly based on their present understanding and their experience. And don't try to rush it. Don't try to keep up with me. Don't try to keep up with my other students that are doing well. It's at your own pace that you learn this. That's the best pace to learn it at. So don't try to feel like you're behind or you're trying to catch up with the class, because I have students that go back to 1996. So you're never going to catch up to them. So I want you to take a look at that price movement here. If this is a market that you'd be trading or interested in learning, these ideas are universal. So it's not a matter of it only applies to futures or only applies to index futures or Forex. It's universal. Okay, so as long as there's a price feed attached to it and it can be traded, these conceptual ideas can be applied to it. Okay, this whole idea from this run up to that level there, this is what I refer to as buy side delivery. Okay, so when price is running higher, it's offering buy side. It's giving the marketplace buy side as it's running higher. Now, for the purposes of running above this high and this high, it's running up to engage the liquidity that would be resting above these relative equal highs. So the distinction here is the directional movement when it's going higher, prices in a buy side delivery. Liquidity above a single or a group of highs, that is buy side liquidity. That's orders that are pending, whether it be a buyer to break out and go long or to protect a short position. So liquidity is a stagnant price level or levels where stops would reside. Buy side delivery is the actual animated movement of price moving higher. And as you probably would have guessed, when we're looking at price going lower, this here is what I refer to as sell side delivery. So the express purposes of running above these relative equal highs, that function has been performed. So now price could, if we're bearish, move lower and then trade back below the previous rally low. So it's buy side delivery to the upside to engage liquidity, trap traders long, and smart money would go short here and write it back down to stop out any individuals that were lucky enough to be long in this but kept a stop loss here or inside this run up during the buy side delivery. Their stop loss will be tagged out. And again, with the premise of reaching for the new engineered sell side liquidity, which would be the sell stops on longs that anyone would have been going long here, their stop loss would be priced right below here. So it's the rally up to take buy side and then rip right back down to take the sell side on those individuals that were trying to go long and weren't astute enough to reverse or at the very minimum close out in a profitable position. Now, as I promised, we're going to look at it through the lens of open, high, low, close candlesticks. So take a couple minutes, look at this before I continue. Pause the video before I start talking and make observations about what you think you see here, what's salient to you. And when you're ready, unpause the video. right? So what we're looking at here is basically the same idea of price action. Instead of a line close chart where every fluctuation is only noted by where the interval will be utilizing that closing price only, not the highest high and the lowest low, but the closing price. Here we're looking at the highest high and lowest low and the open and close of every individual candlestick of this respective time frame. So we see the relative equal highs here with this high and this high here, and the market rallies up here. So all of this is the buy side delivery and a subsequent sell side delivery, attacking the sell side that was created after the run higher. And this run higher attacks the relative equal highs here where liquidity is. So markets go up for two primary reasons. One, it goes up to engage buy stops, which is buy side liquidity. Or it goes up to an inefficiency. What is that? Well, if you look right here, that's an inefficiency. We have this small little segment of price action where the previous candle's low stops here. The next candle opens, trades up a little bit, goes lower. The next candle we open, trade up, stop here, and then we move lower. This separation between these three candles here, one candle in the middle, this is what I call a fair value gap. It's a very specific price level that we look for, and it's one of the most visual things that you can see from our repertoire and the things I teach. Your eye should jump right to it when you see it. And in this case, if you've missed it, you can see clearly now it's highlighted. So because it's a down closed candle, what kind of inefficiency is it? A fair value gap classified as a SIBI, S-I-B-I, sell side imbalance, buy side inefficiency. Meaning when these form, the market's algorithm that produces the fluctuations in price, not because it's buying and selling pressure, but the market rallies to these predetermined levels because it has to offer what? Here, this one single candle went lower. So what does it need to do if it's going to be an efficient market? It needs to trade up back in between these two price points. This candle's low, this candle's high. We see that here. This candle trades up to it. Where does the close stop? Right at the high of it. The next candle, we open and we trade back down. Yes, there was a small wick here. Yes, there was a small little wick here. That is acceptable. That's permissible. But the bodies tell us the narrative. So all of this rally up here was under the pretense that we would see it just simply trade back to this little area here above the buy side, above this high and this high. So ICT, how far can it go above these relative equal highs? You'd have to look to see if there's any close proximity inefficiencies. In this case, we have one right here. Notice this candle's tail goes way lower. Then we open, trade back up, making the low of the fair value gap. And then we trade here lower. Then the next candle we open went lower. So all of these three candles here, we've had a lot of back and forth price action. There's no fair value gap here. We can clearly see there's a gap because there's only one candle making that defined range of that low of that candle and that candle's high. So that small little area here is a fair value gap. The algorithm will go back to that and reprice to it. How? By going back up to it and offering a patch, filling in this only one singular down close candle. Now we have an up close candle laying directly right over top of it. So it patches over the inefficiency here in price. So right away, you can see while this discussion is primarily market maker models, to understand what my market maker model is, you have to understand a plethora of other supporting studies. So while it may be one of those things that you're all going to try to gravitate to over time, just understand it's going to take a lot of time to understand the full magnitude of what's available in terms of deciphering and reading price. It's not just simply, here is a time of day, here is a fair value gap, and where's the draw on liquidity. When you're using a market maker sell and buy model, you're looking at multiple draws on liquidity, and you have to be more nimble So I'm saying this not to discourage you, but to remind you that it's going to take a whole lot more effort than you probably realize going into this. I've made available very, very simple, straightforward, elementary models using the concepts I've created. So if you get discouraged after this, just know that you can always revert back to the Silver Bullet or the 2022 or optimal trade entry models. They're very simple. So let's go into greater detail here, how the market ran up into this area here. Let's focus on how it went down, not just simply below the sell side of that original rally up, but it went down to this old low right here. Look real close, you'll see that it went just below that. That's not random. This right here is a buy side imbalance, sell side inefficiency. It's the opposite of this singular candle here. It's an up close candle. So it wouldn't be a SIBI, it would be a BISI, buy side imbalance, sell side inefficiency. So it digs into this just by a little bit, but specifically right below that low. Again, that's not random. These are things that I like to look for. You can also see how we had that same thing occurring here. This is a buy side imbalance, sell side inefficiency. Again, the opposite of this. Up close candles that create a fair value gap or inefficiency is referred to as a BISI. The classification by PD array is fair value gap, but it's an up close candle, so it's a buy side imbalance, sell side inefficiency, meaning the price will want to go back down to it eventually. And in here, we have that imbalance, and it trades where? Down. Once it gets into there, reprices to the order block, then it rallies back up, creating the initial stage of what? A shift in market structure above this high here. So now we can look for a retracement back down in. So as it's retracing, we're anticipating the price doing what? Eventually reaching for the high here and here. So we can look for a lower time frame to give us a scenario where if we think it's going to go above these relative equal highs, and we can see that this fair value gap wasn't hiding, it's in plain view. It should stand out on your chart. That's why you're encouraged by me to annotate them when you see them. So if you see a draw on liquidity that's setting up above or below the marketplace, don't just limit your focus to that. Look in close proximity just above these buy side liquidity highs here that are relatively equal. How far can it go above it? Well, looking over here, there's no inefficiency here, but there is one right there. So how far can it go above these relative equal highs? There. And look where the bodies stop. Okay, so that's not random. All right, so we're going to zoom in here a little bit, drop down into a lower time frame chart here, and don't worry, I'll let you know what this is as we get to the close of the lecture, but just stick to what I'm showing you here. We have the low, buy side delivery, trading up into the fair value gap that was on a time frame that was 60 minutes, but now we're on a 15-minute. So this time frame here is a 15-minute time frame. It's 1/4 of what was shown as the previous chart. So there's 4 times the number of candles. And I've given you a reference point that it was based on a 60-minute or hourly fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. And still you can see the bodies respecting, and only the candlestick's wicks are piercing it. See that? So that's very, very indicative of qualifying the fact that we went up to a specific level, and therefore we can trust that the algorithm is kind of like broadcasting to those that know how to look at it and see it, that it's likely to now reprice lower. Reprice to where? Below this low. And any accelerated run below this low, how far can it go? Is there any inefficiencies over here? Don't look at this one because that's above that low. We would already be anticipating a retracement back below that. Where will we look? The rejection block, which is the lowest down close. And then we have these relative equal lows here. And you can see it just goes a little bit below that low right there. We're going to get into this in a moment. For now, just notice that we have ran above that buy side, that old high here, that old high here. Shift in market structure on the hourly chart above this high here. So it's retracing. What's it retracing back down into? The fair value gap, order block. right there. So now, does the market offer a consolidation? That's what we would be expecting here. Is it consolidating? Is it offering a small little pause in price where it goes sideways for a little while, which would be accumulating long positions? That's allowing smart money to accumulate longs. I'm going to zoom in. This is the same time frame, okay? So it's 15 minutes. Here's that low. You can see how we just went below it right here. See that? Here's that low inside the fair value gap with the order block, which is a down close candle. Again, we would be anticipating some measure of consolidation, not dropping lower, consolidation, because that means we would be anticipating a run above the buy side here and the previous high that's to the left outside the scope of what I'm zoomed in on now, but you can see it's still being highlighted. And then that 60-minute fair value gap in the form of a sell side and bounce buy side efficiency, that's here, okay? So what we're going to do is we're going to drop down to an even lower time frame and see if there's any more detail in here with a 5-minute chart. So now we're inside of a lower time frame, 5-minute chart, and I've highlighted now this little area right down here. I told you we would talk about that. In here, we're looking at a balanced price range. A balanced price range is where the market has both a downside and upside, or sell side delivery and buy side delivery that overlap one another in the same relative range in price. So you can see how this candle's high, that candle's low. That would normally be what? A sell side and balance, buy side and efficiency. But look what's happened over here. We have a high, a big up close candle, and this candle's low. So what does that make this? A buy side and balance, sell side and efficiency. So there's an overlapping between a SIBI and a BISI within the general area of the same price range. So I'm using the low here and the high here. So that way we can see how this becomes a balanced price range. These are trapped traders. Okay. This in here is a trap trader, or trap traders that would have been caught short. In the classic days of commodity trading, if you were to see old patterns like what would be considered an island reversal, okay, this is the closest thing that I can kind of use to describe what's occurring when there's a balanced price range when it's extreme like this. So when we have a big decline, large range candle that's down, and then eventually, not like months later, not weeks later, but when it's a big drop and a handful of candlesticks like this. It's not a whole lot of candles, and eventually, rip back higher. That means that this was someone that's been caught. They're short, and they quickly reprice and leave them down there. So when I see that, I look to see where those two reference points are, where the market drops quickly for sell side delivery, and then when it rallies back up quickly, those one big candles down, one big candles up, all the price action below it, I would view that as trap traders. So that means by itself, that gives me narrative that it's probably going to go higher. So now cue up the idea of what would it be reaching for? Well, we see it was dropping back down into an inefficiency here, the buy side here, and the old high back to the left, and that 60-minute fair value gap, that's a SIBI up here. We're still in a 15-minute time frame, by the way. I miscued it earlier, calling it a 5-minute. See the idea of the market consolidating, that's what we're showing here. Now, how am I referencing this consolidation? This is the part of it that becomes like a knack, okay? You might not have the exact candles framed like this when you see an original consolidation. So when I call an original consolidation, that is where the market is accumulating. So what I did here, I seen these two candles here, and then the body of this one, and the body of this one. So right away, my eye jumps to that because it's what? It's a smooth edge. So I want to use that as the high of the original consolidation. What's the low? The lowest low. See how easy that was? So when I'm looking at the original consolidations, I'm looking for a repetitive overlapping or reoccurrence of a level that's being constantly referred back to inside of a consolidation. Now I'm anticipating the market to go higher, to go above the buy side here, and then reach up into this inefficiency up here. But I'm anticipating also that it should offer some measure of consolidation, because if it's going to do that, my premise behind swing trading is it's all on the basis of a market maker sell model or a market maker buy model. That's what swing trading is. Whether you realize it or not, whether you want to subscribe to it or not, that's what the market's doing. It's not doing harmonic stuff. It's not doing Elliott wave stuff. It's moving on the principles of running to liquidity, or it's running to inefficiencies. And if it's not doing that, it's consolidating. And if it's not doing that, it's highly manipulated, and then you're having some kind of manual intervention, some kind of shock and awe, surprise rate announcement, some kind of wartime event, something that would destabilize the marketplace that you can't and I can't predict before it happens. Okay, so that's always the underlying incurred risk that we have as speculators. So this area here is where I'm framing that. You can see still, look how many times it's referring to that same